morning, everyone, and welcome to another episode of Pay Attention, our podcast. Um, I think one of the topics that has I've gotten the most fire from is the topic of pricing in payments, and it is one of the most controversial topics I think in payments today. So I have a friend and guest today joining me to help me take some of the fire. And Hello, Kira Lissin. Please introduce yourself, and we can get it started.
Yeah, hello, good morning. Yeah, thanks a lot for having me here. Yeah, I'm Kirill. I'm the co-founder and CEO of Taurus. We are the SaaS intelligence platform for the payment industry, helping its players to get more clarity exactly on the scheme fees and optimize the profitability of payments in the end. And we started that because we have a lot of folks on board who used to work in the industry for decades. So I personally spent some years at MasterCard back in the days. So my partner spent a lot of years working so largest acquirers and processors. So we saw the question of exactly pricing scheme fees and interchange from different angles. And now we try to kind of get more transparency to the industry through a product.
So that's also how we got introduced, and I think one of my something between a hobby and a fetish is I like to ask merchants how much they're paying, and it always amuses me the looks of confusion. Embarrassment, and sometimes even confidence that is based on absolutely nothing that surrounds the answers that I'm getting from people to something that should be very, very simple. So I thought in the in order to do this service or this service, maybe we can start by talking about like the different components of what makes up merchant pricing, because I've noticed that this is also something that people may not necessarily be aware of, and people don't really understand. Even if they do know more or less what they're paying for, they don't understand what it's comprised of, and why do payment services providers or acquirers get to these figures, or how it's done.
Yeah.
So
Yeah, exactly. So yeah, basically it depends on the size of the merchant. So it's still the so-called blended trade is quite popular, right? When the merchant gets just a single amount, saying, okay, that's like 2%, that's your rate, and that's it. And they not all of them indeed really understand what's behind. And so one of the, I guess, important tasks for acquire right now is to also to bring this transparency to the merchants, because merchants are asking about this transparency. And basically on the acquirer end, typically there are also like three major parts of the pricing that they have. So they have their costs, what they're paying within their relationships between them, the payment networks like Visa, MasterCard, and the issuers. So the first one would be the interchange. So interchange is basically paid in a normal situation by the acquiring bank to the issuing bank. It's kind of in the end, it's the potential source of funding for the issuing bank to stimulate the cardholders to use the card. And from this amount, by default, neither Visa nor MasterCard are not charging anything. So they just work like rails, transferring money from the acquirers to issuers. So that's first one. Then there is, I would say, one of the most complicated things within the pricing is the scheme fees. And that's exactly the portions of the equation when the networks charge these fees from both acquiring and issuing banks. And the area is quite complex because there are different types of fees, but like in a nutshell, these being charged from both issuing and acquiring banks. And also, so as any type of business, so acquirers should have their own margin. So that's why they typically put some markup on top. And then in the end, this sums up to either the blended trade, and they assume that within the blended trade, they should have some markup, some margin inside, which is not always happening by default, because again, the issue of lack of transparency goes to like through the whole value chain. So acquirers do not fully understand the structure of their costs, and then this is inherited down to merchants. But also there's another one which is called Interchange plus plus, when acquirers try to explicitly show the merchants, okay, here's my costs. So that's the interchange I paid for this transaction. That's the scheme fees I paid, and that's my markup. The difficulty with this one is that if like markup is like fully transparent, is fully understood, interchange is also like more or less understood, at least by the acquirers, while scheme fees in many of the cases is not fully understood by acquirers as well. So we saw that even some large acquirers quite often use some portfolio average. So they just divide the whole amount of volume they had, the fees paid by the volumes, and then okay, they say, okay, this is my like average fee that I paid, let's say like 40 basis points, and then they apply this fee to every single transaction, which is not that correct, because in reality, the the amplification between the fees in different types of transactions might be times different. So that's why that's also like one of the issues to be handled with them.
So you threw out a lot of I would say a lot of bombs here that I wanna tackle individually.
Yeah.
So first of all, just in terms of like recapping the different elements. So we have the interchange, which is the fee that basically goes and is collected by the schemes, but it goes to the issuers.
Yep.
That fee, and this is important to say that, because again, our audience is coming from different countries. In Europe, the interchange fee is regulated. So that means that throughout Europe, it is the same fee, and the schemes are not allowed to charge more than a certain percentage.
Yeah, indeed. But at the same, so it's regulated for consumer cards. That's why recently, after the regulation came in place, there were a lot of like new banks on the issuing side, starting with the commercial cards. And funny enough, so what we see, for example, from our data, even though the share of commercial cards is not that large, so it might be around 10% of the whole loans, but the contribution to the weighted interchange is actually quite high.
Yeah.
So even despite interchange is formally regulated, so still the average is way higher than the caps for the consumer cards.
I usually save my manifestos and rants to the end of the podcast episode, but you've raised a big issue that, I think it's quite obvious that the schemes they're not non-profit organizations, and obviously when you push them in one direction to sort of stop them from making money in one place, they will find other avenues, and schemes, issuers, they will find other avenues of making money, and that manifests itself in, as you mentioned, in the commercial cards that are not regulated, and also in the scheme fees that are also not regulated. And I think we've seen a most of I would say the fog of war is around the scheme fees, where it's completely unknown what you're paying for, what even the categories don't make sense. So maybe you can shed some light on that.
Yeah, so on a high level, because yeah, sometimes we see that sometimes the players, they're even mix interchange and the scheme fees, but then within the scheme fees, yeah, like unfortunately, it's not the case that that's just some fixed amount per transaction and that's it. So there is a very large amount of fees charged. So literally there might be hundreds, sometimes even thousands of individual items. For example, I remember back in the days when I was working for MasterCard, so the rulebook was around like 500 pages, which is quite large already, but nowadays it's more than 2,000 pages. So it's a bit difficult just to read it and then remember. So on a high level, the fees can be split among two groups, so the fixed ones and the like floating ones. So the fixed ones by default usually do not relate to the amount of business that you as a member of Visa or MasterCard is doing with them. So meaning this can be some membership fees, some services, some reports, penalties, for example, because we, for example, for Taurus, we have penalties within our product as a separate fee, But usually for like issuer acquirer, it might be a separate challenge just to identify that this specific fee is penalizing you for something. And then there's the large group of these like volume-based fees somehow. So meaning you get charged by transaction, depending on its volume, on its type. Then you can be charged by if you're issued by the number of cards that you have, and also there's a large group. Basically, what we see, these two groups, they're a bit different in terms of their contribution to the whole amount of fees. So, for example, the share of fixed fees will be a bit higher for the issuers, and it will be a bit lower for acquirers. So usually for acquirers, majority, so between, I don't know, 80 and 90 something percent comes from the volume related, so like floating fees. And with them, there are some, transactional ones, authorization, cross-border, some other stuff. And so usually it's a bit less that you can do in terms of optimizing the fees as an acquirer, but it's definitely a thing that you need to have like better understanding, especially when then you put these fees down to your merchants.
And I'm gonna ask you a sort of a controversial question. I mean, it's maybe I have a theory that we kind of have the same mind on this, but why is it so complicated? Why can't, it's always been complicated, and it's becoming more complicated every year. Why not make it something simpler?
That's an interesting question. So first, so it looks because there is a lot of legacy. So like card payments, they were developed for like, I don't know how much, like 50, 60 years already, right? And also like large networks like Visa, MasterCard acting as oligopolies. So they kind of tend to make it a bit more and more complicated by adding new fees, new services, plus they're innovating a lot. And for that, they also start charging something. And in the end, it kind of grows more and more, and you can hardly find a single person within the network who like fully understands what they're charging for. So also they at the same time they kind of benefiting a bit from having this like lack of transparency, and that majority of the players do not fully understand what they're paying for. On the other hand, so we are in talks with both of the networks, and so both tell us that strategically they see it as not a kind of sustainable advantage, because you, on the one hand, you're getting a bit of extra revenues. On the other hand, this creates confusion in the market, and in the end, so their customers are the banks, so like issuers, acquirers, so they want to have them happy. So they are discussing some initiatives potentially internally to kind of bring a bit more transparency, but as large organization with that amount of legacy, so it's not doable for them to simplify it at once. So
So
that's why I think we still have some job to do here.
I think maybe this is the difference between us. So you sound very optimistic and looking at the positive of the situation. I think that there is a lot of interest in keeping things complicated, because there is a term that I really like in English called obfuscation, and that
Mhm.
is you hide something within too much information, because it's kind of like when you go to a restaurant, and that restaurant has a menu with 30 pages. It's very difficult to decide or to know what you want to
Yeah.
eat, and it's very similar. So if you have something like scheme fees, and it contains like 50 different clauses and categories, it's very difficult for you to know how much you're paying, and then it makes it easier to sort of stuff other things like your margins, and say, yeah, it's all part of that
Yeah.
thingy that you don't understand. And this is why I got into a lot of trouble about 2 years ago. Actually, positive trouble, because it did cause some good traction on LinkedIn. But we got into a very very heated debate on LinkedIn, because I said that I don't believe in interchange plus plus pricing, and I had a lot of conversations with a lot of crusaders that really are proponents of the interchange plus plus model, and I personally I don't believe in interchange plus plus. We'll talk about it in a second because I know that you do, but let's first maybe just recap, because you mentioned blended rate and interchange plus plus. So let's just explain for those that are not they don't understand the terms, just what it means. So if we look at the like the pricing that we said is made up from the interchange, scheme fees, and the acquirer PSP margin. If you combine all of these three together, and then you tell the merchant you're paying X%, regardless of how these components are divided in between them, you have a fixed percentage that you pay per transaction. That is called a blended rate, because that rate is a blending of all of these different three different components. And the certainty is in the merchant side, and the uncertainty is on the acquirer side, because the acquirer doesn't know how much a transaction will cost until it's actually done, and the merchant always knows how much they're paying for a transaction. And organizations don't like uncertainty, which is why in the interchange plus plus model, the model is we take the cost, we add to the cost, which is the interchange and the scheme fees, we add to the cost our margin, and then this is what you pay. So you always pay cost plus a fixed percentage. And that puts the uncertainty on the merchant side, because the merchant doesn't know how much they will pay until the transaction goes through. But the acquirer or PSP always know how much they're making off of every transaction.
It's like have an asterisk in case they how they really know their cost on that transaction, because right now they're majority of them, so they just understand it at portfolio level, trying then to like dissimulate it. Plus, sometimes we see there's something a bit in between. So some acquirers might say not just it's kind of not a single blended rate, but it's okay for local, for like domestic transactions, that's one rate, for international ones. So it's not interchange plus plus, so they still taking some risk on them, but they at least try to, based on the transactional patterns within then certain merchants, to like to split the risk somehow between them. So
yeah, and this is part of the problem, because the challenges that what a lot of proponents of the interchange plus plus pricing say, and it's true, by the way, that I don't disagree with that, is that the interchange plus plus pricing is more transparent, and usually if you know your costs, you can pay. When I say you, I mean the merchant, because we are looking at it from the merchant side. The merchant, you will pay less overall, because if there is uncertainty, nobody wants to lose money, so the margin or the markup is going to be higher. So overall, I would say that interchange plus plus pricing can be lower for the merchant, at least at face value. My problem with that is that I have yet to meet a merchant that knows their what they're paying, and they can calculate actually what the interchange and scheme fees, what the real cost will be. So they never have any idea how much they're paying, and I ideologically have a problem with that.
No, same here. So we used to deal more with the acquirers and issuers, but I would say market is pushing us a bit down the value chain as well. So we were at the MP, so Merchant Payment Ecosystem event in Berlin, like earlier this year, and we were approached by some merchants. So meaning large merchants, they do have some either like payment divisions internally, so they at least someone who is looking into payments. Some of them are even thinking of creating their own payment vehicles. But merchants were telling exactly, okay, I have my interchange plus plus. I do understand the markup. That's the easy part. I'm somehow I'm trying to understand the interchange, but the scheme fees is a black box. So I'm not sure that my acquirer is not putting anything else in the scheme fees, because there's no way I can check it, no way I can verify that. So yeah, that's the challenge. That's the issue indeed.
One of the things that you told me in one of our first conversations was that, and to me that kind of blew my mind, because I always, it's like, I've been in this ecosystem for a very long time. I know that merchants have no idea how much they're paying. And I did know that some acquirers also don't know how much they're paying. But what you said that blew my mind was that virtually no acquirer and no issuer knows how much they're paying, or very few of them do.
Yeah.
If there's any acquirer or issuer, I don't mean you of course know what you're paying, but the others don't. And the size of and the darkness within that black box is just incredible.
Yeah, indeed. So and then as you mentioned, so it's multiplied by the growing complexity. So it's keep on getting darker and darker.
Yeah, and that makes sense also why there is such a push. I don't want to. Okay, I'm gonna say it, a bit of a dishonest, in my view, dishonest push towards interchange plus plus models. I understand why there is such a push, because and it's being marketed as being more transparent to merchants, but in actuality, it's more transparent or less or reducing risk for acquirers and PSPs. And again, because they also have issues with understanding, what they're paying for. So that kind of leads me to the next big question is, what can we do about that? From a merchant's perspective, if you are a merchant and you want to get more clarity, or you want to understand how things work, or there are a few CFOs listening to this, and I know from conversations with them, they are very frustrated, because there is nothing that frustrates a CFO more than not knowing what they're paying for. So what can we do? What can merchants do about it?
So I would say that they can either try to like exactly understand better why they being charged that amount. So either try to like reconcile them somehow. So they're limited in the access to the information, but still, so there are ways that they can try to get more transparency, like verify. So either using transactional data, try to simulate what should be the interchange and the scheme fees in this specific transaction case, and then sum it up to like their daily, monthly volumes, at least on a high level. First, start verifying that they're charged more or less within the same amount that they should have been. And some, as I said, so we see that some like large merchants, they even thinking, okay, let me have my own, I don't know, PSP to run this, to hoping that this will get more transparency on board. So we look at this probably more from this angle, to kind of that get more transparency, to understand it better, to have better negotiation power when discussing these with acquirers, either for the blended trade or for IC++, because we heard from the market that sometimes the merchant takes a set of their transactions and gives this to several acquirers, say, can you calculate IC++ for the same set of transactions? And they have different results. And then they need to choose somehow. In most of the cases, they will choose the lowest one. But again, to be honest, it might not always be the most optimal case. So if those guys just miscalculated this set of transactions, they might do it vice versa on the other volume. So that's why we believe, and that's what we are double down here in Toros, that we believe that transparency might save this world somehow.
Yeah, I think this is one of the things that it really impressed me the first time I spoke to you. You guys are on a mission to shed some light into this huge dark hole, and trying to get people to really understand it. And I think this is something that I think is amazing, because knowledge is power, and people need to know, people need to understand, and they need to have this power in order for them to be able to make better, more informed decisions. And this needs to be across the whole ecosystem. And I think overall, this is a force for good. If we know more, then we can make better decisions, and I think it would benefit everyone involved. The second thing that I would say, could be also a recommendation, and again, I'm putting it completely out there. I'm not hiding it. I am 100% biased about this, but I think that currently, at the stage that the payments world is at the moment, most of the merchants, definitely SMBs, so small and medium-sized merchants, they don't have the ability to know their pricing, and they have the ability to know their cost. It could be because the acquirers, PSPs they work with, they themselves don't know their costs, or they don't necessarily have the knowledge, tools, capacity, willingness to share that with the merchants. So I would say, I think that in such cases, a blended rate, even if you do understand that you are paying a bit more, and that what you're paying may not be the most optimized pricing, it's at least simple, and simple also has benefits. So I would not discount completely and say, yeah, blended rate is terrible, you always need to choose Interchange plus plus. I think for a lot of merchants, Interchange plus plus, they end up paying more rather than less because they can't calculate the real cost.
Yeah, could be, but I guess it also really depends on the size of the merchant and also on their kind of transactional pattern. So is it something that more or less, I don't know, coming from the same region with the same tickets is more predictable? And then it's one story. I guess probably the risk with IC++ are a bit lower. But if you expect that you may like once you may have some like growing volumes from some like international customers or things like that, which may increase your cost as well, which are hard to predict. That's the other story, and maybe hedging that with a blended rate, paying a bit more, but still that it's more predictable might be a solution indeed. We even like talking to acquirers. They're also trying to innovate because especially some smaller guys which have less like market power, not just like squeezing everyone, but they need to be innovative because one of the reasons we started and the vision that we have at Toro is that so the market is growing double digit, but it's becoming quite crowded. So you need to be competitive yet profitable as a payment provider. And then you need to innovate. And we see that some of the acquirers, for example, they think about, okay, I can even for a small, like very small merchants, I can even provide some fixed costs. So saying, okay, you will pay me, I'm just making the numbers by now, €1,000 per month, and this will cover your volumes up to X, and that's it. So meaning as a merchant, you are fully clear on the cost that you will need to have for that. And so it also is kind of quasi blended something. So could be one of the reasons. But again, for those cases, the acquirer, it should be able to calculate the cost on their end, because if you're transparent, then you can play around this. If you're not transparent, so you either try to like relocate this lack of transparency down the road, or you kind of bear the risk on your end. So, yeah.
Yeah. And you mentioned something that's also very important, and that is the characteristics of the merchant. So because the interchange and scheme fees, they're all comprised of a lot of different components, the more I would say the less variance you have in your business model, the more or the easier it would be to calculate and to get to the bottom line of your costs. Because if you know, I'm a UK merchant, all of my clients are in the UK, they're all using debit cards, they're all using this, it's going to be a lot easier for you to calculate the cost than if you're a merchant selling to 120 different countries and a combination of consumer cards, commercial cards, debit, credit, that doing transactions with 3D, without 3D, etc.
Yeah.
So that complexity is also something that adds to also to the cost and not just to other aspects of the business.
Yeah, indeed, because there are a lot of like parameters influeing on the interchange and the scheme fee as well. So like basically the more risky transaction is for the network. Like, yeah, if you have 3D, it's a bit less costly. If you don't have, it would be a bit more costly. If it's like e-com, is basically more expensive than physical POS. And then, yeah, credit cards are more expensive than the debit cards. Commercial cards are a bit more expensive, probably not because of risk, but just to make some more money on them than the consumer cards. But so yeah, and in the end, so it's kind of very large multi-dimensional matrix where you have those parameters like sum it up to actually bring down to specific fee within the rule book. Yeah.
The last thing I wanted to sort of ask you is because you have your ear to the ground and you hear all the different things that are happening around this sphere, but are there any future trends, any updates, anything that people should be aware of as of we're recording this in June 24. So if you're hearing this in 2028, it's probably already happened. For instance, in the US, the changes to the interchange there is something that's been the talk of the town in the last couple of months.
Yeah, so there are a few. So the one is, yeah, with this like that Visa Mastercard like showed some intention to limit the interchange rates for the next few years. Which again, it's not that explicit how it will be happening and what will be the impact, but pretty much there will be some impact on the industry. At the same time, there was a fresh research by the payments regulator in the UK, explicitly exactly showing that the scheme fees are growing. They're super complex, and that basically acquirers do not fully understand why it's that and what they're paying for. And on the other hand, like recently Visa announced, and so even when I was working back in the day at MasterCard, and I think that I'm still personally and with the companies that, so these large guys like Visa, MasterCard are quite good in dealing with the potential competition. So they're not fighting it, saying, no, you shouldn't be using like account to account, just use cards, but they're jumping the same train, trying to innovate there as well. And then they try to lead the competition rather than fight with it. So Visa recently announced that the kind of the card will be used for different types of transactions like account to account, BNPL, some other stuff. So basically, so you may have these new APMs, so alternative payment methods, but then using the same old rails of, in this case, Visa, because it's like payments is a matter of scale, right? So now, as the largest networks in the world, so they have this like very wide acceptance plus the issuance, so which is very hard to beat from scratch. So that's why even when there's like very alternative things like crypto, so we've seen this a lot that that crypto guys then they go to say, hey, we want to launch a crypto card, which is like white labeled by some BaaS provider, and then it uses like Visa, MasterCard rail. So for us, for
Closes
example,
after
it means
3
that,
months.
yeah, that each transaction there will actually have double the fees because there will be some crypto fees, which are by default, by the way, not as easy as sometimes they try to be like presented, but also it will have the same old like traditional card fees, and because it has this like fiat part which is running on the card fees. So meaning there are some changes coming in, but still sometimes they're kind of coming back to using the same infrastructure, and which is even then further like increases the complexity we're talking about today, right? So that's why I think that we'll have some like job to do in the coming years.
Yeah, definitely. And I know it's going to keep us busy, both of us dealing with this and dealing with all of the complexity and the confusion and all of the misdirection that we see around pricing.
Yeah,
Um,
yeah. Even the alternatives also. So we, I guess, or I would say that I'm personally down on the like centralization. So because we see that like CDBCs, so they try to be regulated, then in the end, so there'll be some pretty much there could be some like middleman, some like infrastructure provider, which would be approved by the some government entities in the end, which will be meaning like breaking down the whole initial idea of crypto payments if you have some middlemen in the middle, so it's a bit different. But then we might see another like oligopolies with using the same model as we see with like the large card networks today. So yeah, it'll be interesting to have a look at that within a few years. Yeah.
Yeah. So with that, I think because we could keep on talking about pricing, I think for at least another hour or so, and maybe we should save something for the next episode. So thank you very much, Keel, for joining me today and for helping me shed some light on this very important and confusing topic. And yeah, let's hopefully we can talk again about this. Maybe after we see some changes and maybe things we can start seeing in which direction some of the future trends are headed. Would be interesting to revisit and see if we were right with our pessimistic views.
Yeah, it'll be interesting. Yeah, thanks a lot for having me. Yeah, it'll be great to like reconnect and have another look at that sometime later. Yeah.
Awesome.